Hey traders, welcome to Charts and Coffee. We are looking at the aftermath of this morning's CPI data. And I'll tell you, I'm as shocked as anyone. Not that the number was better than expected. It was. So let's talk about the data. And then I'm just going to get into the trade that we did this morning, and it's still open in the Sector Secrets Mastery. For those of you that are wondering, Rag, how do you trade an event like this in the morning? It's a futures trade, number one. Number two, the timing is based solely on the setups that I find 15 minutes before this major macroeconomic data, and that's the CPI. Jerome Powell said, look, we look at inflation data, and if the inflation data is pointing to we can cut in September, we're going to cut. A cut in September should be very bullish to gold. It should be very bullish to treasuries. It should be bullish to the indices. However, what we're doing during that moment in time at 8:30 and for 3 minutes after the data is released, for 3 minutes, 180 seconds, I'm looking for price movement to reach a very specific area, an area that we predetermined as early as 10 minutes before the release. So take a look at the data. This is all very much something that would be in line with the Federal Reserve saying, yep, we've got to keep September in the loop. 78% expectation. Gang, 80% is where I look at this as being fully discounted. Are we going to get rate cuts in September? Look, there's still the rest of July to get through and the rest of August, non-farm payrolls, more PCE and CPI data. But where we sit right now, we are telling Jerome Powell via the Fed Fund Futures, which is a futures contract like anything else, like corn, like wheat, like S&P, where traders make a bet on what the Federal Reserve is going to do at the different meeting dates. And right now, September 18 is a cut. Now, what about July? Any expectation for a July cut? None. So don't worry about July. This is all about September, and this is leaning far more towards a cut than it has, I think, in the existence of this contract. Very likely we're going to get cuts as long as we're lingering up here. But what was the trade? So let's walk into that. What was the trade here this morning? All right. And gang, as far as reactions go, right, I'm going to measure everything via Fed Fund Futures when it comes to what the Federal Reserve is going to do. It's one of those things, and we've been talking about this since Q3 of last year. So if you think about, Rob, what have you been doing in your trading in the Sector Secrets Mastery? We've been, by and large, looking at long swing trades since last October, November. This year, we've been extremely bullish. I can count on one hand the number of times I have been long puts on a swing trade this year. It simply makes little to no sense to be bearish in an environment where the Federal Reserve is preparing to cut. And again, we hit all-time highs. How many times this year? So that's the way our trading has been mapping to. Okay, but what about this day trade, Rob? Tell me what you did. So I'm going to show you a little bit of what we did. And probably the best way for me to do this is to actually, give me one moment here, is actually to show you some charts of what we were doing. Now, I use the hourly price movement ranges for this. So this is an indicator that measures time and volatility. It's very different, by the way, than, say, average true range. It's a completely different calculation. Same gist, right? What's the potential volatility of a market or the current volatility of the market? But this is calculated completely differently. So earlier this morning, as you can see here at 9:29 this morning, this was what these hourly price movement ranges look like. This is the S&P. And here's the NASDAQ. That red zone and that green zone is where I'm either going to park my limit orders to sell, that's the red zone, or my limit orders to buy, that's the green zone. We were slightly below the previous session close, and we had a little bit of a downtrend that we were wiggling out of in the ES. So it was slightly bearish, but I was open to either side. So I bracketed this. Now, if you bracket with limit orders to buy and limit orders to sell, you can leave them both out there because whatever gets triggered first gets you in the market. The other one ends up being a second target. So this is what we saw before, right? So we had limit orders to sell up in here. I'm going to show you the notes that we had right here. You can see this is what I set up in the Sector Secrets Mastery. Again, well before we got the release, we placed our limit orders. And you can see here, we had limit orders at 20,937 and a half, limit orders to sell at 20,967, and limit orders at 20,996. Now, 996 did not get triggered. None of my conservative fills. So I'm always scaling in, right? I have these predetermined levels that I let the members know, hey, this is where we're going to scale in. I don't tell y'all later on. This is what we know. We all know before the trade happens. So that's where I want to scale in. Actually, look at the red zone there on the ES. You can see that at the bottom. And I'll flip over to the ES chart. There we go. And that was sitting at 56.93 and a quarter, 5700 and a half, and 5708. We never saw 5708. So I had an aggro and moderate scale in on the move higher on the hot zone. All right. Then what do? We had to do a little bit of active management on this one. Now, I don't like the word active management. It doesn't mean that I'm going to tell you what I did after the fact. What I mean is I had to actively look at where potential break even or scale out levels could be. Now, this is day trading. So our mastery members are in the room with me. We're doing this live. We're setting these levels up before they get there. So what happened is we shot up. We held the red zone really nicely. So I thought, you know what? This is really good CPI data. And straight up, gang, I really thought TikTok, I'm going to get stopped out of this one. We had a really great trade like this on non-farm payroll, but it was an easy trade. It moved up, hit our limit order to buy, hit our limit order to sell. It was almost too easy, but I was not expecting that for CPI. Fast forward, 8:30, boom, straight up we go. And my limit orders are just bing, bing, and they're filled. So now I'm short the NASDAQ. Now I'm short the ES. You can, of course, do this with micro ES and with micro NQ, but the levels are automated. You can choose to place the orders there. You can choose not to place the orders there. But I love automation of our zones and our indicators, right? And then I'm at the helm looking at this dashboard of information, which is being generated in an unbiased, unemotional way. The indicators aren't trying to agree with me. They're not trying to please me. They are just what they are. So I've got this great objective set of zones, and then it's my choice to react to them. But the only thing I can do in a red zone is, again, trigger those limit orders to sell. And that's what happened. So let me show you what the ES looks like right now. And you can see right here on my notes exactly what we set up before the hot zone. I think we set these up about 10 minutes before the hot zone. So I was open to potential buys, but that's not where price went, right? Price shot up. You can see here the high was 57.07 and 3/4. That means that my red zone limit sells were triggered at 56.93 and a quarter and 5700.50. Okay. As long as I stay in the red zone, I don't have to pull the trade because that red zone should act as resistance. And then on the way back down, we moved to break even. We scaled out and ultimately hit the previous session close where we wanted to take our second target. We tightened up the stops, and I'll show you my tightened stops. Again, we're doing all this live, putting this in the notes so everyone's on the same page. There you go. So I was left with 1/4 of my overall position at 5 minutes to not 10. 5 minutes to 9, and I wanted to tighten my stop to 56.97 on the ES, and actually I really wanted to do it 86, 87, but I'm going to tighten those up a little bit more. Yeah, mastery folks, I know we got a bunch of y'all listening. Yeah, let's tighten that up to, it should actually be 56.89. Okay, let's tighten that up to 56.89. Go ahead and scale out or close the trade out. I think it makes a lot of sense to do that before the bell. And then NASDAQ. Yeah. And I have my tighten stop at 20,905 where I locked in profit from the short that we took. Scroll back up here as you can see the alert where we took the short from 20,937 and a half and 20,967. So again, that's 62 NASDAQ points from the moderate level. All right, so what does that mean? So 62 points from the NASDAQ level is $1,200 per contract. And by the way, from the 20,937.5 down to 20,905, right? You've got 32. Multiply that by $20 per point, and that's $650 per contract, right? So that's what the Nasdaq did this morning, and those were our day trades. Straight up, I was not expecting a pullback after that CPI data, but this is where I say trust the process, right? I was thinking the entire time, Rog, you're going to get stopped out of this. That data is so good, but then what do? I shelf that, and I say, but we're in the red zone. We're in a resistance zone. This is an exhaustive zone for this move, and I'll just trust my process, but place my stop, right? And I'll aggro more aggressively, start to find ways to move to break even and scale out. And that's exactly what I did. The target that I was looking for, and my mastery folks, when you watch the replay, we were actually looking for 20,876, 879. We actually got the target. Who would have thunk it? But we did. And I'm glad we actively managed on the way down, because with that data, this could have been a very different morning. On ES, you'll notice we just fell short of that initial target, but we had the two others that we already scaled out at. So that's where we sit. Gang, when you're trading futures, you're trading a highly leveraged thing. Micros are leveraged too, gang. It's just that the points per dollars are so small that traders think, oh, it's safer. It's really leveraged. So whenever you're wandering into things like futures, please remember, they do trade nearly 24 hours a day. I love them. And my SPX fans out there, you want to get a jump on other traders that are waiting for the SPX to start to calculate indicators and get up and running, watch the ES. It's been moving and grooving since, basically before the Asian session. So you get a lot of data, you get a lot of information about what's already been happening. You can have your volume data, volatility data, price data on the ES, but trade the SPX as the ES futures, which is this nearly 24-hour market, does its thing. Okay, so think about that as well. All right, so that's what we've got here on that. And I wanted to at least walk y'all through that trade. And so let's get to some of the questions here. Now, what is this hot zone going to do to treasuries? It's going to send them higher. What is this hot zone going to do to gold? It's going to send it higher. All right. Anything that suggests that the rate of inflation is coming down and bond yields are pretty steady. The chasm between the rate of inflation and the shorter end of the yield curve is known as real yields or real interest rates. And when those narrow, gold goes up. And that's exactly what we're seeing here. Gold moving higher from the daily price movement range, support gray zone. I would not anticipate a whole lot more out of gold today, gang. So for those of you that are looking at gold, we've moved today from the DPMR support, our volatility-based support, to resistance. That resistance is in the gold zone, kicks off at about 24.14.5. The upper end of that zone is up near 24, call it 27. So yeah, we could have a little bit more, but this is likely going to be the bulk of the move for gold today. Doesn't mean I want you to short, but I will say if you're waking up to some gold profits, at least scale out of half the position and move to break even. All right, which is what we like to do in the mastery. All right, moving on over to bonds. Again, bonds are going to reflect the expectation for lower yields as soon as September. They're going to move higher. Bonds have probably made about the sum total of their move here. We actually hit both the conservative edge of each of the support and resistance zones of the gray and the gold. We could push to a standard deviation. Of course, that's always possible. I wouldn't want to be too bearish bonds. But again, with this hot zone, a lot of the major moves have happened, quote unquote, pre-market, right? Before the bell even rings on Wall Street, a lot of moves have already been made. All right. And if you're wondering what the CME Fed Watch is sitting at now, 81%, gang. Jerome Powell's waking up, looking at his Bloomberg terminal, looking at the Fed Fund futures and saying, okay, they're going to expect us to cut. So unless the data between now and September 17 suggests we shouldn't, That course is set, gang. So every PCE, every CPI, every non-farm payroll release is either going to wither away at this, kind of chip away at that probability, or increase it, We'll know better, obviously, come September. But right now, the way the broader averages, the treasuries, the currencies, the metals are going to move is in anticipation of a quarter point cut. All right. So that is on tap. CPI firmly put that in play. All right. We've been focusing mainly on the long side in the mastery, and there's a reason for that. Rate cuts are never bearish, gang, and neither are all-time highs. So feel free to give me your downside targets. I've been hearing them all year long. But gang, please, I say that only to remind everybody, trade what you see, not what you think. And fear-mongering is meant to be clickbait and stick around and watch our advertisers. That's it. So anytime anyone's talking bearishly about this market, I wish what would happen is the commentator asking these questions would say, so what have you been doing as the S&P has gone from roughly 4,700 to 5,700? What have you been doing these last 1,000 S&P points? Picking tops, right? That never does come up, but I wish it would, because when folks are picking tops, it ain't the first time, right? It's the whole process of, well, a broken clock can be eventually right. So please, gang, the trend is up. Treat it as such. All right. There's no reason to be bearish right now. If we start to see reasons for bearishness, they're going to be tethered to a lower expectation to September cuts, not no cuts. How many folks have been running around saying they're going to be no cuts this year? I wonder how that's been working out for them too. Remember, gang, sometimes folks will just be bears because they're not already long. So remember, it's a revenge trade. Okay. What else do we have? I'm getting a little salty this morning, but it kills me when I get emails from folks who are not Sector Secrets Mastery members saying, Rag, I'm not long. I said, well, get with the program. I can't tell you that it's going to keep going up for another 1,000 points. But as long as we start to respect what the trend is doing, we can at least buy the dip, which I know is often mocked, but it does work. It's an opportunity cost. As far as movement in things like yen, remember, yen is going to be very much tethered to risk appetite. U.S. dollar should weaken with this data, but so too should the yen. But here, remember, gang, the yen and the U.S. dollar have a relationship to each other, their central banks, and then also the carry trade. Yen strength is actually a little bit of a misnomer, because it's really U.S. dollar weakness. So, that's a little bit more Forex conversation. But for those of you looking at currencies, remember, gang, you've got to know what the driver is. And if the driver is U.S. dollar weakness as the U.S. prepares for rate cuts, and typically the currency of a country is going to be weaker as that central bank gets dovish, this is really not indicative of anything other than U.S. dollar weakness. So this is not yen strength. This is no reason to panic. That's not the way that I'd be looking at it, and I've been trading Forex for about 25 years. So yeah, I would not look at this as a, oh my gosh, the yen is strong. No, the US dollar can be weak and still send dollar yen up. All right, gang. So that's a wrap. I hope that gives you a good idea of what you can do with futures contracts pre-market, how we use those hourly price movement ranges, automate your analysis, but ultimately you are the captain of your own ship, and worked out really great this morning with CPI. All right, gang. I'll see you tomorrow. Same time, same station. Be good to each other.